Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide online valuation services for mediation and litigation based in St. Louis, Missouri. Today, we'll be discussing business valuations when the future is unknown and the past is not reliable with my special guests, Josh Shilts and Stephanie Swetland. Josh's practice focuses on complex financial matters and disputes. He frequently lectures on forensic accounting matters and has been involved in hundreds of investigations involving personal and business disputes. He also has provided expert testimony in commercial and family matters around valuation, economic damages, and fraud. He's been qualified as an expert and testified in state and federal courts. Stephanie Swetland is also a licensed enrolled agent and is a QuickBooks Pro advisor for both online and desktop. She is continuing her education in accounting and plans to obtain her CPA license within the next couple years. They are both forensic valuation experts and offer tax advice in the state of Florida. Stephanie, tell us a little bit about some of the things that we might want to look for because we're going to see so much PPP or idle loans or things like that because they do affect the valuation. But even just letting people know that they need to look for some of these things, like where are they going to be? How can they throw off the valuation number?
So from what we've done, we're going through tax season, business deadline just passed yesterday. And the way we've kind of handled it, especially regarding stimulus, right? Because I feel like that's one of the biggest things. And in valuation, we use book and tax, right? To reconcile and make sure that what's actually being reported is in line with the books and there's not too many things out of whack. So I think that there's going to be a big emphasis on M1 and M2 adjustments on the tax returns, because if someone received PPP in 2020 and did not apply or receive forgiveness in 2020, then we still have to report that. So the way you do that is on the M2. It's an M2 adjustment. It's other non-taxable income. And then when it's forgiven, it will go and offset that in the following year. So I think that it's important that valuation professionals understand these items and also the way that the expenses will be handled, because initially the expenses were not going to be deductible if PPP funds were used to pay them. They turn around and are allowing those expenses. So you should see that and on the P&L, and then the only offsetting thing would be that M2 adjustment for the PPP funds. I think it's also important, though, that we all understand that PPP wasn't the only thing available to small businesses. The EIDL loans were also available. Those loans were payment deferred, but they are still liabilities. The interest rates were great, so it was a great way for small businesses to take out a large loan. Most of them, even on $600,000 of revenue or so, you could get roughly $500,000 at 3.25% or so. So it was a good way for small businesses to refinance debts and things like that. But I think that valuation professionals need to look at that. And see.
I would also add on to that, Stephanie, the forbearance agreements that have been out there. I think that a lot of that has helped prop up businesses because they didn't have to pay their debts for 6 months. It's funny, I was talking to a receiver, an individual who does bankruptcy and receivership work, and a little slow right now, but curious to see in the next 90 days or when the forbearance ends. What does that mean? And here in Florida, again, I go back to where I'm at. Tourism is a big part of our industry. We're not worried about Marriott. We're not worried about Disney World. We're worried about the local hotel operators that maybe have, a Motel 6 or a First Choice or whatever, that were servicing this. They've been skating by because of that forbearance. Anyone who deals with an asset-intensive business where there's real estate or land involved into it, we understand a little bit about the game there for the taxes, but the appreciation. Well, they haven't, their cash flow you don't really make debt adjustments right now, right? But if you go back and you were to make a debt adjustment, you're starting to see that some of these companies are truly insolvent. And no, their credit card balance is good now, but if they had to pay those debt obligations, I don't think a lot of them will make it. So, Melissa, you and I, when we first met, we talked about the pandemic economy, and we're in certain phases of it. At some point in time, stimulus and forbearance will end. What will that look like? And sorry to cut you off, Stephanie.
You're fine. I think, but to that point, I think that it's also important that as professionals, we recognize that. And so if we have a valuation date that's, say, November 30th of 2020, and that's dead in the middle of forbearance and things like that. So then we need to make sure that we do those cash to accrual adjustments to look at that. And if those debts were due now, what would that look like? Even though they're not, we know that that's going to happen, so it should be considered.
I agree. Going back to your first question, Melissa, I'm seeing a lot more interest in how we do valuations.
Right.
Here's an equity valuation versus an enterprise valuation. This is how the two can join. Here's liquidation value versus a going concern value. And those terms that, the three of us, we understand those terms. And how many times have we said, I don't understand why the attorney doesn't understand that? Well, it's our job to educate them on that. And so there is a lot more explaining these, what I call blocking and tackling concepts, to attorneys, to clients, and aligning, hey, a liquidation value means we're stopping operations today and we're fire sailing. Going concern, well, let's talk about a going concern and what that means. When it comes to family law here in Florida, discounted cash flow, there's a general agreement, if you will, nothing written in statute, but we don't use discounted cash flows because those are cash flows in future marital efforts. So we're doing a capitalization of earnings. Well, if I had free cash flow of 100,000 for 4 or 5 years, and I'm doing a November 20, and the cash flow is 40,000, do I do an average? Do I believe this company? And as you know, in litigation, we don't get to do a range of value. We don't get to sit up there and say, hey, based upon this assumption, based upon that assumption. We got to come up with a number, and we got to be. So the forensic aspect of making sure that your assumptions are supported with facts. What evidence supports that? And I've been talking to other professionals around the country who, Josh, how do you handle this? Because it comes down to reasonable certainty. How certain are you of these assumptions? Are you accepting them just because the attorney? Well, if you're going to do that, you better state that and just be very transparent there. Otherwise, you as a professional could get yourself into trouble because they think you're the one coming up with it. So,
and I think even current financials are becoming even more important. If we're sitting right here in March, normally I'd be like, well, wait till the quarter's up, or, we'll look at a June date. But now it's like, no, I really need to see every month, because like I've told a lot of people, like, we're a year into this pandemic. I think we have another year to 18 months to kind of this still economy where we're trying to integrate back. And so in that perspective, in the past, we could just look at, okay, give me 3 to 5 years. Now it's like, no, I really need to see every month. Like, I need to see how you're progressing. Is this progressing forward? Is this stagnant? Like, did you have a good month, right? And it popped up, but it's not really moving the needle.